Good morning, ladies and gentlemen. Thank you so much for joining us today. Money Show is delighted to welcome Michael Lee and Doug Flynn. Mr. Lee is the president of Michael Lee Wealth Advising, a proprietary trading firm also specializing in financial consulting, advising, and wealth management. Mr. Flynn works with high net worth individuals and their trusts, business owners, media personalities, professional athletes, and other high profile clientele. Gentlemen, thank you so much for joining us. The floor is yours.
Thanks so much, Rena. As Rena said, I am Michael Lee. I run my own wealth management firm, Michael Lee Strategy. I am here with my good friend Doug Flynn, who also runs his own firm. Just a little bit by way of background, you may recognize me if you're a watcher of Fox Business. I'm either doing Maria Bartiromo, Charles Payne, or Stuart Varney's show pretty much every week, and then sprinkled in on some of the other programs. I've been in the industry since 1999. Started a small firm, then spent a little time at Merrill Lynch, but most of my career was at Morgan Stanley. At Morgan Stanley, I worked with not only high-level corporate executives and small business owners, but some very large institutional accounts, some of the larger fixed income accounts in the world in specific strategies, as well as some equity hedge funds. So split my time between the institutional equity and fixed income side, as well as the wealth management side, and now focus primarily on high net worth individuals and helping them turn their life savings into income vehicles so they can live the rest of their life with comfort. Doug, you want to?
Yeah, absolutely. So thanks, Mike. Yeah, I've been in the business since the late 80s. After the crash of 87 was when I decided I wanted to get into investing, figuring that was the worst possible time to do that. So that would be the best possible opportunity to do that. And been in it ever since. So actually been working in this industry and doing exactly what I'm doing since 1989. And in 1997, founded my own firm with my business partner, and have always been doing financial planning and professional investing the entire time, and been a CFP since 1993. So always with a financial planning tilt, but ultimately managing money for clients' goals, whatever that is. And so focusing on total wealth management and all that goes with it. But during that time, also doing a lot of media and different networks throughout the years as people move around. And that is where I met Mike. Actually was in the green room of Fox, and a couple other people. As you know, it's a very small world. So just working together and running in the same industry for a long time, and got to be good friends with Mike. So that's basically our background. And I guess from there, Mike, we could talk about the topic today.
Yeah. So we've had we've had an unprecedented 18 months. And so you've got some great slides in here, but my takeaway is that some of the equity bounce back is very similar to the last crisis. But this is also had a lot of differences, but to see where markets are, and kind of all the different things going on in the world, the resurgence of COVID and the fears, the lockdowns, what can we look forward to for the rest of the year, given that the S&P 500 is already up 18% and hitting brand new highs today?
Yeah, jumping off of that, if you think about the last 16 months, 13 of them have been positive. We haven't actually had a 5% pullback, just a 5% pullback since last October. And typically in a normal year, you're going to have several 5% pullbacks, and usually on average, 10% pullback. And it hasn't happened. So where do we go from here, and what do we make of that? And the market's sitting at all time. How do we take advantage of that? So one of the things we wanted to do is take you through some of the things that we look at. And you'll see a couple of slides here on this one. It's not about any slide in particular on any given day. One of the things when you're investing over the long haul is you're looking at trends and you're looking at the differences over time. So I pulled this slide. If you look over here, you'll see this is as of April 15th. And what this is looking at is this is the forward PE ratio of the S&P. And so at this point, you can see it's more than one standard deviation from the average. So that's a cause for concern from a valuation standpoint. But it doesn't really affect for the amount of the stimulus that's behind all this. Nevertheless, this is where we sat in April. And so, okay, here's where we are. And then if you go and bring it more to the most recent end of month, it actually trended down. If you look here, the PE ratio went from April of 22.7 to now about 21. And part of that isn't because the market has come down, it's because of earnings. And so here, if you look at earnings per share, this chart goes all the way back to about 20 years, 25 years, and you'll see the progression of earnings. You'll see some dips here in 2008. This is where we were last year with the pandemic, but look at the projections. This is consensus estimate for earnings over the next 3 years. And what you'll find is that the projection is off the chart higher than it is now. And so typically over the long haul, as earnings go, the market goes, because that's what drives the market over the long haul. Of course, as you know, when you're trading, anything can happen in the short run, and it doesn't have anything to do with earnings per se. But over the long run, earnings are going to drive the market. And if you see a future of all-time highs, Mike, would you agree that that typically means that you have all-time highs of the market behind that?
Yeah, Doug. And then one other thing, I want to chime in here. As January starts and earnings estimates come out from from the big banks and all the different Wall Street analysts. Okay, historically, these are the most optimistic people on the face of the earth, and they greatly overestimate how much companies are going to make in the year going forward. And as the year goes on, earnings estimates steadily come down, whether you're in a flat market, bull market, bear market. These are the most optimistic people. Well, something has happened since the kind of COVID recession, and that these analysts are undershooting earnings estimates dramatically. So on March 31st, or I think in January, the estimates for this quarter were about 30% growth. Okay. At the end of March, the estimates had increased, not decreased, from 30% to 53%. Okay. On June 30th, they went from 53% to 63%, and now we're tracking just below 90% growth. So historically, if we're going to have 90% growth, that sounds like a great number. Obviously, we're coming off one of the worst quarters in the history of the S&P 500. So 90% growth seems like a little bit normalized. In a historical sense, those analysts would have been predicting 100% growth, and coming in at 90 would be still pretty good. But that's the history of Wall Street estimates. Okay.
Yeah.
What we're seeing right now, and I think part of the reason why the markets keeps hitting these new highs, is that the people are saying these estimates and these consensus estimates you have circled on this chart right here are simply too low. And they think that, there's a lot of reasons we can get into a little bit later why, but the fact is that people that are pulling the trigger, the buy side, the mutual fund managers, the hedge fund managers, their research is telling them that those numbers are too low. And so they're out there buying stock, thinking that instead of that forward PE multiple, with consensus estimates saying it's 22, 23, from where I'm sitting, it's 17 or 18. So that's inside of that one standard deviation.
Let me jump off of that too. Typically, on average, to Mike's point, the actual earnings come in about 75% of the time. 75% of the companies beat the analyst estimates. We're running close to 90% of the companies beating analyst estimates. If that holds through the end of this earnings season, it would absolutely be the highest on record of all times of earnings beating the analyst estimates. And that's to Mike's point about earnings being undershot in terms of how they're looking. I want to drill down and take a look here. This is the PE ratio. We always hear about the FANG stocks. The top 10 holdings in the S&P make up anywhere to about 30% of the entire market. And I'd like to break it down. This is quite interesting. If you look here, the overall S&P, as you just saw right now, has a forward PE of 21, which is sitting above its average. The top 10 stocks in the S&P are sitting at a multiple of almost 30 times. And what we're trying to do is talk about, okay, we hear about are the top 10 stocks. That's all we focus on. That's what's on TV every day. What if you looked at the other 490 stocks in the S&P 500 as a beginning point? You'd notice that the PE ratio, when you split out the S&P overall, take out the top 10, is down to 18.7. So now all of a sudden, you have a lot more opportunity, perhaps, in those other 490 names, which don't get all the press in the market every day. So these are the kinds of things that we like to look at, is where are the opportunities? Sometimes the opportunity is in the top 10. Sometimes it's not in the top 10. And that's what you want to focus on is where can you go from here? You might also hear a lot about the difference between value stocks and growth stocks. And when, should you have value? There was some outperformance of value, and now people are wondering if growth is going to kick back. So I love this chart because over here, what you'll notice, this goes back to 1997. You can see clear times when down here, value stocks are cheaper, and up here, when growth stocks are cheaper. And so right now, you can see we're sitting at a point when value stocks are cheaper. Now, listen, they can stay cheaper for an extended period of time. But what it tells you is your next dollar, especially if you're already extremely overweighted in growth stocks and in tech and other areas, perhaps should go into the areas where when things are cheaper. Just like up here, the last thing after having value run for a long time after the financial crisis was people wanting to buy growth stocks. That's the time to buy it. And now you look here and you say, this is clearly saying value stocks are cheaper right now. That doesn't mean they're going to outperform forever, but there could be some opportunities here. And just to bridge off of that, and then I'll throw back to you, Mike, is here's year to date. This is through the end of July. On the right side here, you see the growth returns in large, mid, and small companies on the growth side. This is the percentage return. Small growth is up 5% year to date. Look at the value side. Small value is up 23%. I can almost bet that most people are sitting underweighted on the value side of the equation. And here you have year to date where the value side of the equation has outperformed the growth side. I don't know if that continues. It might be earlier in the game just because of where the valuations are, but you're sitting at a point where value stocks are undervalued relative to growth, and they're starting to show signs here and there of outperformance. Whether that continues, I don't know, but you want to do a little bit of a look and say, do I keep chasing the top 10 growth stocks all the time, or do I look elsewhere? Mike, what do you think?
So I think what you've seen in the growth stocks and this outperformance of growth we've had basically since the financial crisis ties into what you're seeing in the inflation data today and this inflation argument overall. And it's that post-financial crisis, such dramatic structural changes were made to our banking system so that the velocity of money has collapsed. And our government has expanded dramatically and population growth has slowed. So all those factors combined lead me to come up with the argument that we exist in a low growth, low inflation world. And so people are saying, oh my God, but what about all this inflation we're having? Well, when you compare yourself over the horrific quarter we had a year ago and what we're going through a year ago to now, it's once you strip out airfares, hotel rooms, used cars and new cars because of the chip shortage, you're looking at about a 2% annualized rate of inflation, maybe even a little bit less. And if you think about all the money we've printed since 2009, I believe the U.S. federal debt at that point was about 12 trillion, and now we are knocking on the door of 30. The Fed balance sheet was less than $1 trillion. Now we're knocking on the door of 10. This 1970 style hyperinflation that a lot of people are expecting is just not coming. And so when there's very little population growth and there's very little inflation growth, so goes the argument, maybe you disagree with me on that, a Coca-Cola, how much is the price of a can of Coke going to go up? Okay, maybe a little bit here and there. But if there is 3 or 4% inflation, a can of Coke that is going to increase dramatically. And so the rotation to value we had earlier this year, which is kind of the first major rotation to value, and the U.S. the Treasury yield got very, very steep. Bonds sold off dramatically. The idea behind that is that, and tech got crushed. So the idea behind that is, why am I going to pay 30 or 40 times earnings when I can buy, a high quality company at 15 times earnings or 14 times earnings? That's now going to have 7 or 8% organic revenue growth, half of that coming from inflation. Well, if inflation is 1% or 2%, and that organic revenue growth is now 1% or 2%, Companies that can grow their revenues by 25 or 30% are going to trade at 3 to 4x the valuations of companies that are only growing their revenue 1 or 2%. So that's the battle between value and growth you've seen play out. And it's all about, in my opinion, inflation. And so while the money supplies, the amount of money that's out there in the system is increased by 25%, in the last 14, 15 months, which is insane, the velocity of money, meaning how quickly it makes it through the system, has grinded to a complete halt. So while value looks cheap, it always just because it's markets can remain irrational or for longer than you can stay solvent, right? And so if anybody's seen the movie The Big Short, there was that guy Michael Burry who was betting against the mortgage market for a few years. He lost all his investors because it took so long for those trades to pan out. And so even though he ended up, quadrupling their money, it took so long and it was against the investors' wishes. They don't want to deal with someone like that. And so I'll tell another little anecdote. The company I was working for, Morgan Stanley, they had massive bets against the mortgage market going into the financial crisis. But what they wanted to do is it took so long for those bets to play out. They went long mortgages in a different vehicle, and they underestimated how bad the mortgage market was going to fall apart. And so that vehicle they went long in, the initial trade that they were paying for ended up paying out 7 or 8 to 1, and they made $2 billion on it. But the other trade they put on to kind of offset the cost of that trade lost $16 billion, net losing the firm $14 billion on one series of trade, and almost taking Morgan Stanley out of business. So it's value can stay cheap for the next decade or two.
It can.
Right?
Let me jump off that, Mike. So in the late 90s, that's when you got into the business, I think. So we, if you remember, a lot of people probably were not investing through the 90s because they're too young. But if you were, or you remember, or you look it up, you'll find that there was that great tech boom of the late 90s, 97, 98, 99. And in 1999, as an example coming back, and you can see it over here, large cap growth in tech was up tremendous. And small cap value as an alternate was negative in 1999. If you fast forward 1 year into 2000, you might remember that was when the tech boom bust, and then you look, huge losses on the growth and tech side, and small cap value was up over 50% that year. And all I'm saying is that I think that there are points in time when you want to have a little bit of exposure in these other areas, especially when you see things like this. It can still live below valuation for a while, but you don't want to be adding at the all-time highs into the thing that's already at all-time highs all the time without just giving a nod to some of these other areas. That's I think one of the key takeaways from here, if you will.
Yeah, absolutely. And there needs, regardless of how you manage money, there always needs to be a tactical element, right?
Great point. Yep.
So
here's another example of in 2020. This is like momentum stocks were up huge, and value stocks were down. And now look at year to date, it's completely flip-flopped. And so do you just have one and try to time it and flip to the other, and now we know value and now it's going to flip back to growth? Or do you have both of those, or start maybe your next dollar, you start bringing in some of these other things, you start to balance them between, because then you can play both sides of it. Because this is what happens. There's a cycle. Momentum in tech doesn't run all the time at the top. It can run for an extended period of time, but you never know when that time has changed. And so these are things to think about when you're running your own money or client money. At that point, I wanted to bridge over to just talk about the U.S. relative to international. Unless, Mike, you had another point about growth versus value of the market overall.
No, I love these quilt charts, and it just goes to show you that not every year, but if you're looking to place new money to work, you should be looking at the bottom of the chart, not the top of the chart.
Excellent point. In fact, I want to put the U.S. This is with the U.S. versus other asset classes, including the DM is developed markets, EM is emerging markets. All we hear about are, emerging markets. And if you look, this is year to date, the top asset class through the end of July is actually real estate, investment trusts. Here's large cap blue chips, here's developed markets, and here's emerging markets. Commodities have actually popped up to the number 2. You can see commodities over here as the brown. Look at how it's been the last down here, right? And we know why commodities have not performed. We also might know why commodities are starting to outperform. We'll get into that in a second. But before we do that, I just wanted to bring your attention to US versus international for a second. This goes back 50 years and looks at when does the US outperform and when does the international market, as indicated by the EFA index, outperform. And so you'll see on average here, early 70s, this is EFA outperformance, this is US outperformance, it flip-flops. Here in the late 80s, it was EFA outperformed the US, then the US outperformed, back and forth. If you go here, this most recent time, so not only has the length of time that the US has outperformed the EFA index never been longer, right now pushing on 14 years, the percentage of outperformance is also at the highest point. Now, other than over here in terms of percentage. But at some point, look, it can continue on. Maybe it's going to be 15, maybe it's going to be 20 years. But the same thing starts to pop in, just like when you start thinking about value versus growth. In the US, when you look at people's portfolios, we tend to be in the US-centric in what we invest in. Even though globally we're a smaller and smaller part of the US global equity market as a percentage, but we're still the biggest, obviously, but people here are US-centric. Just like you would expect in other countries, they're their own country-centric because it's what you know. Just like when you invest in things you know, that's what you do well with because you know it. But from a diversification standpoint, just like maybe you want to have some value, you begin to think, perhaps it's time to start trickling in some of these top companies that are international. And I talk a lot about, you mentioned Coca-Cola before, Mike, and that's a great example. You think about Coca-Cola, it's a US company. Why is it a US company? Because the headquarters happen to be in Atlanta. That's the reason it's a US company. It's not because 80+% of its profits come from overseas, which they do. We could argue whether that's a US company or not, but we use US domiciling as whether or not we're invested in the US versus there's some wonderful companies outside the US that maybe have the majority of their revenue from the US, but they're not US companies. And so you just need to peel back the onion and think a little bit bigger about where there's opportunities. It's not all US tech growth all the time. That can run, it should be an important part, probably a majority of what you do, but perhaps there's some other things you start to want to look at. Mike, any thoughts about that?
So my thought on international investing is that if you look at what drives equity returns, it's the underlying it's the underlying economic activity in that region. So if you like we just mentioned in Coca-Cola, a major driver of Coca-Cola's growth is in Africa, right? And so you could, in theory, find a competitor of Coca-Cola if there was one and invest in that in Africa, or you could defer to the operating leverage and expertise of the boardroom of a company inside the US. And so I believe in the S&P 500, it's close to 50% of the revenue comes from outside the US. So it hasn't always been that way. Right. You are now. So if there's something happening in Brazil, if there's something happening in Europe, there's something happening in Australia, from an economic standpoint that's really taking off, you can expect a US company to make an acquisition. So Square just bought a company in Australia called Affirm, right, which is a massive grower, it's a pay-as-you-go company to marry those two technologies and move in there. So I think that has largely changed over the last 15 years, which is why you're seeing you've seen this elongated period of sustained outperformance, and then it's also a lot of these other countries, particularly Europe, just simply didn't have the balance sheet to recover from the financial crisis the way the U.S. has, and because the U.S. has, and the U.S. market has, and the capital markets here have recovered, you've seen a lot of international acquisitions and growth. So, this, you look at this chart and you say, why am I putting any dollars in MSCI USA base? But it doesn't, like, as you mentioned, doesn't tell the full story.
Exactly. Mike, I know we're running a little short on time. I wanted to
Sorry.
hit a couple things so we can give you an opportunity to dig deeper. Just a couple things about when you're investing in, you're not just looking at one chart, you're looking over time. This is the chart again from April, and it shows the price to earnings ratio of the EFA index versus the S&P. And you'll notice how severely discounted it is. It's more than one standard deviation away in April. And actually, fast forward to now, it's now crossed 2 standard deviations. One of the things, if you're anything into statistical analysis, is once you start living more than 2 standard deviations away from something, that could spell an opportunity. So just bringing your attention to it to look a little bit deeper. This is my last slide, and then we can go to your slide, your talking points, Mike. I found this really, really interesting because people don't think about what inflation environment are we in and where are we going. If you think about over here, we had been relatively in a low inflation rate environment and it's falling. That's been the backdrop. And when you look at performance of various markets over that period, look, the US market averages 12% during that time. EM is only 2%, commodities were negative, and even gold is only 4%. That's been the backdrop. If you go to, think about skating to where the puck is going versus where it was. If you do go into a currently low inflation rate environment, but rising, right? That's not the same as what we've been in. What works well in a low inflation rate environment with rising inflation? Well, equities still do well. Maybe not quite as well, but as well. Here's where EM is. Here's your commodities, and here's your gold returns. And I think this is part of the process of thinking about, look, we're not in high inflation and rising and high and falling. So, you're not focusing there. We're down here. This is how we've been doing. Perhaps that's how you invest. But if this is the market we're going into, the type of cycle we're going into, if inflation starts to rear its head, more than just transitory, and it becomes real, okay, and growing, which can happen, these are the other areas you want to start to look at. I find this interesting just from a standpoint of positioning your portfolio and thinking going forward, not chasing yesterday. Of course, U.S. equities are there, but these are other areas as well. What do you think about that, Mike?
Yeah, so I think those bottom 2 charts, you have on the left, you have the first quarter this year, and then on the right, you have the second quarter minus gold. For whatever reason, gold is no longer acted like the inflation hedge. And, my thought was last summer is that gold was going to $4,000 an ounce. That has, and so I don't know if it's Bitcoin. I don't know if it's the major players don't believe in inflation, but it's gold has just not acted the way I think just about anybody would have thought.
Yep.
So that's my big takeaway.
3,000 an ounce was the call from everybody. 4,000 was bullish on that for sure, but it has not transpired. So, Mike, we're down to your slides, and then we could do some Q&A before we have to wrap. You want to hit on anything?
Sure. Yeah. So, look, to me, inflation is the whole debate. I think I don't believe. I believe that the Fed and Jerome Powell finally cleaned it up in his last speech. Is that the word transitory is stupid. It's not. It's the way a lot of people on Wall Street. It's a word symptomatic of Wall Street that a lot of people use that. It is really has a very simple meaning, but it sounds like when you say it, it's transitory, like you have more significance than you actually do. So what they're saying is temporary. And if you think about it, we still have massive supply chain disruptions, and they're not necessarily going away. And you think about the economy and these supply chains like a light switch. It's a lot easier to flip it off than it is to turn it back on. And the recovery from this crisis has been so much faster than the 2008 crisis. A lot of people were ready for the last crisis. to happen and this to be prolonged. It has not been prolonged. Okay. And if the most bullish people on earth, the Wall Street sell side analysts, are underestimating the speed of the recovery, how can a guy that runs a manufacturing facility that's doing 20 million, 30 million, 50 million in revenue, especially in a different part of the world? What people aren't noticing is the velocity of money. If you look at the velocity of the M1 money stock, okay, you can look at it from 1970 until now. It is on a steady increase all the way until the great financial crisis. So we leave the gold standard throughout the 80s. That's why we had so much inflation in the 70s and 80s, is because not only was the money supply increasing, but so was the velocity. And it wasn't high interest rates that shut it down. It was the banking system. They had a massive banking change laws in the middle of the 80s. Inflation fell off a cliff, and we've been on a 30-year bond bull market as a result of it. So my opinion is no velocity and no inflation. Okay. Much of the printed money that the Fed is doing. So you've had two sources of money printing. You've had Congress sending out stimulus, and now, today, Green New Deal, God only knows what money's coming from that. And you've had the Federal Reserve. And when the Federal Reserve prints money, the first time they did it was to shore up the capital markets, to make bank balance sheets look better, so we didn't lose confidence in the financial system. Since then, all that really does is inflate the stock market. So what was your historical PE multiple of a 15 is now maybe moved to a 17 or 18. So it does not create that 1970 style inflation. And in fact, when there's so much money in the system, it's hard for it to pick up any speed, decreasing the velocity, working against inflation. So we call it kind of painting the tape. You're making the banks look good, you're making the stock market look high, but you're really working against yourself with that much QE. And so for everyone saying there's going to be all this inflation, how different has this response been to 2009? And did we have runaway inflation from 2010 to 2020? Sure. Some people will say it's 1%. Some people will say it's 3%, but we're certainly not looking at what we saw in the late 70s, early 80s, which is what a lot of people point to. So for me, I'm focused on these US stocks because even though international multiples are cheaper, I view EM, international investing, as a timing. It's a timing mechanism because a lot of it is based on fund flows. Okay. I'm not that good of a timer. So I basically avoid that because I think, out of the 7 years in a business cycle, 6 out of 7, you're going to get outperformance in US stocks. You have better capital markets. You have better operating efficiency in the S&P 500. So you're going to make more money with less risk. I think this business cycle, we're in a new one. We just had a recession. And so the last business cycle went for 11 years. And if we didn't have COVID, we'd probably still be in an expansionary phase. And if you think about the devastation of the financial crisis and the reorganization that happened after the last crisis, that would lend you to believe that we're going to have a very elongated business cycle. Okay, well, this recession, we snapped right out of it. And there were extraordinary actions taken to limit the amount of bankruptcies and the financial reorganization that you typically see in a recession that kind of clears out all the bad and brings in the new. Okay, this was much smaller. So I would expect this to be a shorter business cycle than the last business cycle. But while we are in an expanding business cycle, the market's going higher. Maybe some years you're up 30% and some years you're up 4%, but you're generally trending higher. So as I've mentioned before, it's sell side analysts are too bearish. So I think earnings estimates. So the history is that they take the numbers down right before a quarter. So expecting 20% growth for the fourth quarter. Fourth quarter starts, they're expecting 15%. Analyst estimates come in at 17%. And they say, "Oh, this was a great earnings season." I think those numbers are going to keep going up probably for the next several quarters, which I believe stock's going to get higher. The only thing that I see stopping us is the Fed. So I don't know. What do you think the overall markets right now, Doug?
So just to kind of bridge off of that, I like to have some value. I like to have some international and play the percentages up and down and trade in and out of it, rebalance in and out and take advantage of that volatility. So to us, that's a way to pull extra return out of the portfolio on an ongoing basis. I'm curious though, to think of not having a 5% correction and certainly a 10% correction or 5% pullback and 10% correction. To me, do you chase with new money now at the all-time highs, or do you put a little to work and hold some back with dry powder for that potential opportunity, or do we never get it because we're all waiting for it? Those are the kind of things that are in the backdrop in my head. But I agree that we're in a good spot. There's a lot of opportunity ahead. And it's just a matter of, do we always do what we've just done, or do we just think a little bit differently? And that's kind of what I wanted to bring to the table today. We might have a few minutes if you want to.
Yeah, so I just say, that's the question I get every day, right? Do you put money to work right now? And it's dependent on your time horizon. But if you're investing for more than the next 3 to 6 months, and it's a multi-year investment, you need to put money to work right now. And you're typically not going all in on stocks or all in on bonds. Yeah. And
that's the new definition, I think, of long term is 3 to 6 months, right? It used to be 3 to 6 years.
but if a client gives me $1 today and 60 cents goes into stocks and 40% goes into bonds, and we have a 20% correction, I'm selling bonds.
Absolutely.
Absolutely. I'm selling bonds and buying more stock, and
absolutely.
When that
and riding that up until it corrects, and then you roll it back down. Absolutely. Those are the ways you same scenario. Absolutely. Right.
But there are still people waiting for the pullback from 2009.
Right.
That
right.
couldn't
That's my favorite.
Last March. Yeah.
The market will go up 100%, and when they get to 10% correction, they're finally right, but they missed out on the other 100. So while they're waiting for that 10, it will happen, but who knows how high it goes before you get that 10% correction. So.
You need to be perpetually invested in equities, right? Excellent. And if there's too much volatility, you can take that down out of that dollar. If 60 cents that dollar that is in the stock market, and that's too much motion in the ocean, take it down to 40 or 50, right? But that 40 or 50 or 60 has to stay there in perpetuity, because if you miss the 10 best days of the market over a bull market, you end up with like a third of the return. So
excellent. Rena, I don't know if we have any questions or if we want to wrap, or I know Mike has a live hit on Stuart Varney's show on Fox Business in about 20 minutes, and he's got to run.
We do have some questions, and Mike, if you have to hop out, you're more than welcome to. So I'll read the first one. All right. And by the way, you've sparked a bunch of conversation in the chat. They are loving this presentation. They even brought up 2009 themselves. All right. So first question. Based on the heat map shown before in slide 32, REITs have already gone up. Can one interpret that we are in a low to rising inflation now?
Where's my heat map? Oh. This one. What was that question? What was that last part?
Yeah, no worries. Can one interpret that we are in a low to rising inflation now, considering REITs have already gone up?
What do you think, Mike? Low to rising, that's this environment down here.
I think this quarter and next quarter inflation's peaked. I think I think next year you're going to see supply gluts, and I think growth. I think the next phase is growth slowing, and financial, money printing. And because growth slowing and inflation's peaked, the Federal Reserve will continue money printing, which is going to support equity prices.
Yeah, I would bridge off of that and say what's not on here is a chart that shows low and flat inflation, because that's the one piece that's not here. It's somewhere between falling and rising. And I think that while it might be above trend of where it has been of late, because it was so low, it's not. Transitory is probably the right word, because it's probably going to settle back down to a more normal case of inflation. So I don't know. We've entered into the rising inflation long term. Look, with the amount of printing that we've done, you can see that down the road. I just don't know if we see that tomorrow.
Okay. Hey guys, I unfortunately am going to jump off. Thank you everybody for attending. If you didn't get enough of me, 11:03 on Fox Business.
See you later.
Thanks, Mike.
Thank you so much.
I'm happy to stay for another minute or whatever amount of time you have left. I'm happy to do that.
Yeah, no worries. We can keep going. You've actually answered a couple questions already while you guys were chatting. Let's see. How about where did it go? Sorry, there's so many that just keep popping through. What stocks or sectors do you see as like really good opportunities for the rest of the year?
So I have something here that might help. I mean, you look over here, and on the right side of this sector earnings correlation to GDP, and some of these are on the growth side and some of these are on the value side, right? And so I always look, I don't have the chart here, but one of the charts you want to look at is what sectors have outperformed the most and what have underperformed. As a contrarian investor for a good chunk of the portfolio, we're always looking to the areas that have not performed well. So that might mean adding into things like last year, adding into energy when it didn't look good, those kinds of things. And so I'm always looking at, right now, of course, tech is tech, but looking a little bit deeper into healthcare and the delivery of that is a good play. Utilities is a crazy sector. I love utilities. I know it's unloved and no one even knows anything about it, but here's the backdrop of utilities for an example. Utilities to me are the stealth green energy play. The companies that are going to make money when we shift to, wind or solar and all these other things that we're going to go into are not these fly-by-night companies, think Solyndra and all these other companies that are startups. There'll be some winners there, but it's going to be hard to ascertain which ones are going to be the winners out of maybe 200 losers. But the companies that will do well are utilities companies because they already have a ton of cash flow. They have the money to invest. Just like, believe it or not, some of the oil companies are some of the biggest producers of alternative energy. People don't think of them like that. And that's the look at utilities. Plus, they play a good dividend and they're severely undervalued. But that's an opportunity that you begin dipping your toe in the pool and saying, I can play green energy in a profitable way in something that's not necessarily hitting the radar. That's the way I look at it.
Awesome. Thanks. All right. Next question. Can't earnings be easily more manipulated than other parameters, which might actually accurately reflect value?
It could. Earnings can be manipulated. I think, but if you take that as a backdrop that they can be manipulated and they always are manipulated, then you have the similar backdrop now versus any other time. I don't think it's any different. I don't think they're manipulating them any more or less than they have before. They always do. So then it's kind of equal and you can still take the numbers for what they are at face value and not necessarily in and of themselves, but relative to other things. Just like we were saying, there's a severe outperformance of earnings relative to estimates. So in relation, an all-time high of that is still an all-time high of that, manipulations or otherwise.
Awesome, thanks. And then one final question. Can you speak to the value of the dollar moving forward?
Yeah, look, I think that I don't really like to play the dollar. I think, you have to think about it getting weaker over time. I think that's a perennial issue with the US dollar as these alternate currencies come onto play and people find safety in those things and it becomes more mainstream. But also the amount of printing and everything else that we're doing to really devalue the dollar over time. So you might have that falling dollar as a backdrop over an extended period of time. What's crazy about it to me is the US official policy is a strong dollar. They will look you in the eye and tell you that the official policy of the US is to have a strong dollar policy and then do everything exactly to the opposite. And so I think that you're going to have fits and starts because some of this is relative to the rest of the world. We still are the reserve currency. So you're always going to have that strength for as long as we have that strength. But if you lay that with all these other things behind it, you're probably still looking at an ever decreasing dollar over time. That's the way that I would play it and the things that go with it.
Got it. Thank you. We did have a couple people ask, are your slides available? If you were to send them to us, could we send it to them?
So what's interesting is I borrowed these from JP Morgan. If you look at the bottom, and so you can go to their site and all of this data is available. It's one of the 1,000 things we look at. I just like it because it's so concise. There's so many different things. You can go there and as an individual investor or certainly as a professional, get this monthly. They put out an official one quarterly and even some of it is daily. So I strongly suggest kudos to them. There are other firms that put out something similar, but I just thought for today, this was super helpful. And you can all go to their site directly, JP Morgan Asset Management. I don't work for them. It's just one of the tools that we use. They put together this and over time, I like to compare new ones with old ones. So that's all free and available to everybody out there and absolutely are one of the things that you want to look at to build your own trends.
That's great to know. These are awesome slides. Well, thank you so much, Doug, and thank you to Michael as well for joining us. It was a very enlightening presentation. You guys did great, and we really appreciate you being here.
Good luck to everybody. Happy trading and investing.
Thank you. Have a good one, okay?
Thanks.